The S&P 500 has been through many recessions, with one of the most notable ones being the most recent Great Recession in 2008, where we did see it drop around 55%. But one thing is for certain, we will continue to get more dips, more corrections, and in fact more bear markets the longer you are invested. And a bear market is where we get a 20% or more drop, and typically these occur about once every 3 years. And if we look at the S&P, just year to date, it is only down around 4%, so we are quite some way away from in fact a bear market. But needless to say, it doesn't mean it won't happen in 2025. And we've already noted many stocks across the board, across the industries, are in fact down double digits, including some of the biggest companies in the S&P. Notable ones like Nvidia down 12%, Apple down 15%, Tesla in fact down more than 42%. And the Treasury sector has come out and say the White House is trying to steer clear of what could have been a guaranteed financial crisis under the old administration. But one thing that has been noticed is there is slower economic growth right across the board, which is only increasing the risk of a potential recession, and analysts are now increasing the odds from around 36%, where at the beginning of the year this was sitting around 23%. And just last year, JP Morgan did predict by the end of 2025 there was around a 45% that the US would go through another recession, with Bank of America also warning at the beginning of the year the S&P could fall around 40%. As we said, a bear market is where we get a drop of 20% or more, and forecasters are getting more and more worried with Trump in power as well. They believe an economic downturn is now on the cards, and a chance of a recession has never been higher, which is why today we want to look at 4 stocks that have outperformed the S&P by quite some distance. As we can see, S&P's performance in the 07-09 Great Recession was negative 55, and we're kicking off with Walmart, which was up 7% during that same time period. On top of that, they are a dividend king. They've been paying a dividend for 51 years with consecutive increases, and even during the 07-09 crash, they continued to increase it, whilst also having pretty much flat recession sales when the S&P as a whole was sitting at negative 12. Now, Walmart's a multinational retail corporation. They operate a chain of hypermarkets, discount department stores, as well as grocery stores. They were founded back in 1962, and they're known for their low prices, massive supply chain, and global presence. In fact, they're one of the largest companies in the world by both revenue as well as employment, and they are up around 40% over the last 12 months. Year to date though, not the best start, down 5%, underperforming the S&P during this time, but over the last 10 years, massive outperformance, up to 117%, whilst right now trading at the midpoint of the 52-week range, quite some pullback from their all-time highs at $105, with Wall Street giving this a buy rating. Notice 4.42 out of 5. 4.5 would flip this into a strong buy, so they're not that far off. They also pay a dividend, as we mentioned, in fact a dividend king. The yield right now sitting at 1.1%, and in their most recent quarter we noted revenue up 4% on a year-on-year basis, which is pretty much in line with inflation, whilst also noting 17% increase to their membership year-on-year, and their US comparable sales up 5%. Now, in terms of their earnings, over the next 4 quarters they are anticipating 3 of them to be growth, and over the last 4 they have pretty much outperformed in all of them against analyst targets. 100% track record, meaning if you have faith they'll hit their EPS of $2.64 by Jan 26. They do right now have a forward P of 32.7, which as we can see is quite considerably higher than the 5-year average of 24.3. Now this is what we would call a potential overvaluation signal. Another indicator of overvaluation is dividend yield theory, which typically tells us that a company is undervalued when the current yield sits above the 5-year. Right now we notice the opposite. So what we are seeing today for Walmart is a double overvaluation signal, although bear in mind we're not looking at any one model in isolation, and we will run through our own process in a very little while. And we have another model here that actually tells us the blue tunnel, the expected fair price. Right now there is quite some significant disparity to where the company trades for, and even the upper end. So for Walmart, 3 out of 3 possible overvaluation signals. We also notice they do trade above the sector at 16.2, so you are paying a 101% premium, something that is pretty much confirmed no matter which valuation metric you use. But as always, understand some companies actually deserve the premium, whereas others actually don't, and that is something we should look to identify. In terms of growth, they get a C-, year on year and forward looking around the 4 to 5%, which is above the sector at low single digit 2 to 3, and they're pretty much in line with their own historical figures of 5 and 4% respectively, with the anticipation earnings per share is expected to grow at 9% over the next 3 to 5 years, above the sector at 7.4 and above their own 5-year of 7.3. Now if we look at their profitability, where they get an A+, gross margin 25%, below the sector at 36%, pretty much in line with their own 5-year at 24.6%, and bottom line 3%, a little bit lower than the sector at 4.4%, but again near enough their own 5-year at 2.4%, whilst also generating a ton of cash from operations, 36 billion, that is above their own 5-year of 31, but also well above the sector comparable at 785 million. We also notice institutional ownership sitting at 27%, around 14 billion worth of sales over the last year, but a lot more buying by the institutions during the same time frame, so clearly very bullish. But we also see more than twice the amount of buys than sells in the latest quarter. Again, clear to see institutions are very bullish on this company. Now, as we said, we're going to run each one through our own intrinsic value, where for Walmart today we get $88, which is the average of these three models that you can see. And don't forget, on this channel, we typically run through the models, the inputs and outputs. Today, getting straight to it, we always like to add a margin of safety, where we kick off with 10%. We execute on that if it meets our 3 golden criteria: wide moat, strong financial metrics, and good forward-looking data. Now what this tells us, there is no MOS right now on Walmart. In fact, you're pretty much paying a fair value in relation to the current price today. 85 is the price, 88 is what we anticipate the fair value, but as always, you will probably look to get at least a bit of MOS before executing on any company. 10% at buy at $79, at 15 around 74, and around 20 is probably where we would say is good consideration at $70, and definitely one for a longer term investor who does also want some security in terms of recessions, which will naturally come as time goes on. But again, bear in mind their performance that we saw at the beginning of the episode is historical data, and past performance is not an indication of how they'll perform in the future. Wall Street themselves are very bullish. They see $112 over the next year. They call this a buy now with 32% upside. But as always, give us your thoughts about each one of these companies, and you can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for Walmart or any others. Now, we also want to let you know we have just released our latest free weekly article. We drop one every single Monday morning to your inbox, where we cover severely undervalued stocks as well as what's gone in the market over the last few days. So click below, you can sign up and read straight away, where you'll also be able to gain access to severely undervalued stocks for the month of March. Lots of information for each one, the upside that Wall Street themselves see over the next year, and on top of that, you can grab a recently released copy of 97 stocks that Wall Street themselves believe have the most upside in the S&P right now. So click below, you can sign up and read straight away. The next stock we have is Mastercard, where they had a negative 12% recession return, again looking very strong when you consider the S&P down 55. They also had positive recession sales plus 2%. S&P, as we said, negative 12. However, they did maintain their dividend. They didn't increase it, but they also didn't cut it. And they're a global financial service company. They specialize in payment processing and credit card networks. Founded in 1966, they facilitate electronic payments through consumers, businesses, and banks worldwide, and they're one of the leading payment networks alongside both Visa and American Express. Now, the company is up 11% over the last year. Year to date, up only marginally at 2%, but over the last 10 years, massive outperformance of the S&P, up 515%, trading in the upper end of the 52-week range, a double buy from both Seeking Alpha as well as Wall Street, and they pay a dividend currently sitting at 0.57%. We also see green right across the board, love to note that, with the expectation on their December 2025 EPS, meaning their forward valuation now sits at 33.8, which is pretty much in line with their 5-year average, the same to be said for their dividend, so this is a double reasonable signal valuation, and this is also confirmed when we take a look at the blue tunnel. Right now it is sitting bang in the middle, so all three indicators telling us that Mastercard, which is a high quality company, is trading at a fair price. However, maybe as we would expect, it does trade above the sector, so you are paying a 216% premium, something that we believe the company does deserve, and again, that is reinforced no matter which valuation metric you look at today. In terms of their growth, at a B, revenue year on year and forward looking at 12%, above the sector in the mid-single digit and pretty much in line with their own historical figures. And if we look at the EPS, they're anticipating 14% growth over the next 3 to 5, above the sector at 10, but it does come some way below their own 5-year of 19.7. Profitability, very impressive at an A+. Gross profit margin 100%, well above the sector at 60, in line with their 5-year. Bottom line 46%, well above the sector at 22.6 and marginally above their own 5-year of 44.8. And the cash generated from operations of 15 billion is pretty much 50% higher than their last 5 years on average at 10.2 and significantly above the sector at 144 million. Institutional ownership pretty high, around 97%, around 30 billion worth of sales, but 35 billion worth of buying, and we can see again around 50% more buys than sales in the most recent quarter. Institutions clearly loving the company. And we can also highlight from their latest quarterly earnings, their top line was up 14% year on year, with also efficiencies noted both on the operating profit side up 1 percentage point and their bottom line up 2 percentage points, while also seeing the gross dollar amount up in the double digits year on year. Now our valuation gets to $621 derived from the DCF model. Now it's just one model, so we can show you we have the free cash flow year on year, average growth at 16% over the last 10 years. Just in the most recent period, up 25%. We've gone a lot more conservative at 14. With the discount rate, we get the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, get to the equity value divided by the shares outstanding, $621, and we actually get a margin of safety, unlike Walmart. At 10%, a buy at $559. At 15%, not quite there yet, but not far off, so very near to a 15% MOS, with Wall Street themselves seeing this at 631 over the next 12 months, translating to 18% upside. We then move on to McDonald's, which was only down 3% with the S&P massive 55. Now they had negative 6% sales, but still above the S&P's negative 12, and they actually increased their dividend during the recession and have been paying a dividend for the last 48 years, consecutive increases, meaning they're 2 years away from becoming a dividend king. Now they're a global fast food chain known for their burgers, fries, and quick service, and they were founded in 1955, operating now thousands of restaurants worldwide, introduced through a franchise model, and they are right now one of the most recognized brands in the fast food industry. They're up around 8% over the last year. Year to date, up 6%, outperforming the S&P so far, and over the last 10 years, massive outperformance, up 217%, trading in the upper end of the 52-week range, a buy rating from Wall Street, and a current yield on offer at 2.31%. Now their latest quarter did see their revenue pretty much come in flat, but we did notice efficiencies on both gross profit and operating profit, with their global comparable sales again below 1% growth, meaning that if you incorporate inflation around 4%, in real terms their top line was decreasing. And over the next 4 quarters they anticipate 3 of them to be growth, with actually only a 25% record, only 1 out of the 4 in terms of beats, and right now trading at a forward valuation of 24.9. Now pretty much similar from what we noticed with Mastercard, both forward P and their dividend yield is in line with their 5-year average, a double reasonable signal, and again that is reinforced in this third model here, but it does trade at a premium to the sector of around 62%. Again, no matter what valuation metric you look at for McDonald's as well, it does trade at quite a significant premium. Now growth does come in at a D+, not something you want to see for a company trading at a premium. 2% revenue year on year, forward looking 3%, not far off the sector at 2 and 3% respectively, and just a little bit lower than their 5-year of 4 and 5, with EPS expected growth of 8%, lower than the sector comparative at 11, and a little bit below their 5-year of 8.6. Stability though looking very strong at an A+, gross margin 57%, below the sector at 38, a little higher than their 5-year at 55, and bottom line 32%, that is above their 5-year of 29 and well above the sector at 4, so we are seeing efficiencies, with also an increase to their cash from operations, $9.5 billion over the last year, above their 5-year average of 8.2, and also above the sector at $283 million. Institutions hold around 71% ownership, $9 billion worth of sales in 2024, a lot more buying at $14 billion, and twice as much buying in the most recent quarter, so clearly institutions very very bullish on McDonald's, with our valuation in today's episode coming to $315. Now, we don't get a 10% MOS just yet. In fact, you're not even getting a 5%, so we do believe it is trading near its fair value, which those models did also reinforce at pretty much a reasonable price. But for those wanting 10%, a buy at 283, those wanting 20% at 252 is probably a good time to consider adding to the portfolio if you do like this and fits your overall strategy. And for those that want 25% around 236, and Wall Street themselves at the moment see very minimal upside, $328 over the next year, translating to 7%. And as always, give us your thoughts. Maybe you already hold these for a recession-proof part of your overall portfolio, or maybe you see this as a hold or sell. We then move on to Church & Dwight, which only had a negative 1% return, also positive 3% in terms of recession sales, and they've also been paying a dividend without a reduction for the last 124 years. Now, they're an American consumer goods company known for household and personal care products, founded in 1846. They own popular brands like Arm & Hammer, Trojan, and OxyClean, focusing on value-oriented products and having a strong presence in both domestic as well as international markets. And they're up 5% over the last year. Year to date, they're up 3%, and over the last 10 years, up around 154%. Not that far off the S&P in comparison, whilst trading in the midpoint of the 52-week range, a buy from Seeking Alpha, and a current yield on offer at 1.1%. We can also see the split from their revenue from their latest quarter, where consumer domestic does make up the bulk at 78%, and international coming around the 18% point, and they do expect 3 of the next 4 quarters to be growth, and having a 100% track record, right now trading at a valuation of 29.2. If we were to compare this to the sector, well, again, similar to the previous companies, trading at an 80% premium, and this is again reflected through the other valuation metrics. Some investors do prefer to look at others, that is why we typically like to show them, and growth coming in at a B, year-on-year revenue up 4%, pretty much the same expected moving forward, slightly better than the sector at 2 to 3%, but lower than their own 5-year at 7 and 6% respectively, with EPS anticipated around 7.5%. That is in line with both sector and their own 5-year average. We can also see their forward P and their yield giving us a double reasonable signal, and similar when we do look at this other valuation metric, we can see the current trading price in the middle of the blue tunnel, and in terms of profitability at a B+, their gross margin sits at 46%, above the sector at 36%, a little bit above their own 5-year at 44%, bottom line 10%, well above the sector at 4%, but it does come quite some way below the own 5-year of 13.2%, with cash generated at $1.2 billion, a little bit above their own 5-year at $992 million, and the same to be said for the sector at $785. Institutions currently hold around 87% ownership, $1.7 billion worth of sales, $2.5 billion worth of buys, and again also noted more buying than selling in Q4, so overall, like all companies today, institutions are fairly bullish, and our intrinsic value today at $107 derived from the DCF model, where we have gone for a growth rate of 8% moving forwards, and in fact there is no margin of safety as we see the current price at the intrinsic value. But for those wanting a 10%, a possible buy at $96, at 20% where we would say up for consideration at $85, and at the 25% point around $80, with Wall Street at the moment believing very minimal upside of $112, this in turn translating to 5% upside. But as always, give us your thoughts. Are these 4 stocks that either you have in your portfolio in case we do get a recession in the shorter term, or maybe for long term to have that bulletproof overall strategy? And don't forget as always to sign up to the free weekly newsletter, grab those spreadsheets, come and join us in a Patreon where we do cover our weekly buys and sells. And as always, have a great day. We'll see you all on the next one.